Hello again. We're going to be going through Chapter 5 in this set of presentations. We're moving into merchandising operations, and I'm going to be talking about that and this thing called the multiple step income statement. And in the text, by the way, they give you the example of Walmart, I think, at the beginning of the chapter as a classic example of a merchandising business. So we'll be looking, I'm on slide 3 now. We'll be looking at terms such as the perpetual inventory system versus a periodic system, and a multiple step income statement. We'll discuss the formula for determining the cost of goods sold using inventory amounts and purchases of goods during the period. Try to get a little more centered here. Alright, on slide 4, here's the chart shown on page 228 of the text to introduce the chapter coverage. We will discuss operating cycles, the items that go into determining the cost of purchased merchandise, recording the sales of merchandise, and income statement preparation, including the determination of this thing called gross profit, which is unique to merchandising operations. Here are some examples of merchandising companies and how they interact: wholesalers, retailers, and the customer. Note that the terms sales revenue or sales are used to describe the revenue earned by these businesses, to differentiate from service revenue that we've been using for service providing businesses. Moving to slide 6. This chart, also shown on page 228, shows the differences in accounting for net income in a merchandising business where merchandise or goods are sold. Note that the relationship between sales, cost of goods sold, and gross profit. Then note how operating expenses other than cost of goods sold, are subtracted from the gross profit to enter the net income. So note the flow of things on the merchandising income statement in this way. On slide 7, as stated on this slide, the operating cycle of a merchandising company is usually longer than a service company because inventory has to be purchased, shipped to the store, and then sold. On slide 8, this chart shows pictorially the formula for computing cost of goods sold and ending inventory. This is something you need to commit to memory. And commitment to memory is easier if you understand the logic behind the formula. So let's take it from the top. And while I'm digging out the board here, it's beginning inventory plus the cost of goods purchased equals the cost of goods available for sale. So that's the first part. The second part is that the cost of goods available will consist of two pieces at period end: the goods that were sold, or the cost of goods sold, and the goods that remain unsold or on hand, that is the ending inventory. So when we look at this, I'm going to have to try to find the other pen here. Maybe the cat ran off with it. Just have to dig out another one. All right. And we're going to say net purchases for reasons that you'll see later on. So that's the first part. Beginning inventory plus net purchases equals the cost of goods available for sale. Then we're going to use the cost of goods available for sale, which I'll abbreviate as CGOA. And if we know what the cost of goods sold are, we can subtract that to get the ending inventory. Okay. Now, alternatively, we can also, if we know the cost of goods available and the ending inventory, we can subtract the ending inventory from cost of goods available to get the cost of goods sold. There. All right, so those formulas are going to be important, particularly in the periodic inventory system, where we're only counting the inventory at period or usually year end. Now, note how, as with any equation, the pieces can be moved around to get the desired result, as we just did. And for the income statement, our main concern is determining cost of goods sold. For the balance sheet, our main concern is determining the ending inventory balance. All right, going to slide 9, in a perpetual inventory system, there's a continuous accounting for inflows and outflows of inventory items. Normally, in today's world, this is handled in an automated system, such as SAP or Oracle, for larger companies, and maybe something like QuickBooks for smaller ones. Note that there is a running current inventory balance and that the cost of goods sold is computed every time a sale is made instead of at period end. So that's the perpetual system. On the other hand, in a periodic system that is traditional before common usage of automated systems, there's no ongoing detailed accounting of goods on hand, and the cost of goods sold is only determined at period end. The formula discussed a couple of slides ago is shown on this one. Beginning inventory plus purchases minus ending inventory equals cost of goods sold, or beginning inventory plus purchases minus cost of goods sold equals ending inventory. The difference between this approach and the perpetual system is that cost of goods sold as well as the inventory balance is not determined until period end, whereas with the perpetual system, it's known continuously through each period. On slide 11, this slide points out the situations where using a perpetual system may make the most sense for a business. Where closer, tighter control is needed, usually for higher cost items, it may be worth going to a perpetual system, even if it costs more to do so, because of the perceived and actual benefits. In reviewing this sidebar example here, note that just because a perpetual inventory system is used, this does not eliminate the need for a comprehensive physical inventory at least annually. You might ask why. Well, a perpetual system isn't perfect, and errors can be made in entering data on merchandise purchases, sales, etc. Also, fraud or theft could occur, and a combination of factors could throw the actual balance off from what the perpetual system says it is. So we do need that double check. Moving to slide 13, when a purchase of merchandise is made, it should be supported by a source document, which is usually an invoice. But there should also be evidence of goods receipts, such as a packing slip or receiving report, before the vendor is paid. On slide 14, note that the journal entry for the purchase transaction that is shown on this slide. The debit is to the inventory, or asset, which is an asset account, and the credit is to accounts payable, a liability account. Remember, when those words on account are used, this means that no cash has changed hands as yet. On slide 15, we discussed freight charges associated with shipping the merchandise from the seller to the buyer, the company that's doing the accounting in this case. There are two typical situations. FOB means free on board. This means that the vendor assumes the shipping charges to the location identified. If it's FOB shipping point, then the vendor only assumes shipping charges, if any, for whatever transport there is between his or her facility and the shipping point, which may be one and the same. If it's FOB destination, this means that the seller assumes responsibility for the shipping, that is the freight charges, all the way to the buyer's destination. These terms affect when ownership or title transfers from one party to the other, so they're pretty important. For FOB shipping point, ownership transfers to the buyer when the shipping carrier accepts the goods from the seller at the shipping point. This is huge in accounting for the purpose for the purchase from a timing standpoint, because when title passes, the purchase must be recognized on the books. For FOB destination, title to the goods does not pass to the buyer until the goods arrive at the buyer's destination. This too is a critical bit of knowledge to have for accounting purposes to ensure that purchases are accounted for in the proper accounting period. On slide 16, note how the freight or shipping charges are accounted for depending on whether the buyer or the seller incurs them. When the buyer pays the freight, the shipping charges are debited to the inventory account and thus become a part of the inventory cost. When the seller pays the freight, there of course is no entry for this on the buyer's books, and the seller accounts for the charge as an operating expense called freight out. On slide 17, there are other charges that may affect inventory amounts. A purchase return is a return from a customer that was not satisfied with the product for whatever reason. See the example on page 234 of the text, which shows a $300 return by the buyer, SOC, with a journal entry that debits accounts payable and credits inventory. Take a moment to think about why this makes sense from an accounting standpoint. A purchase allowance does not involve an actual return of merchandise, but does involve an adjustment to the original purchase price due to some fault in the merchandise that does not rise to the level of needing to return it. In this case, the buyer's journal entry would look the same as for the purchase return, just for a smaller dollar amount, a debit to accounts payable to reduce it, and a credit to inventory to reduce that. And now for a review question. And the answer to this question will hopefully be apparent to you after the discussion we just had on purchase returns and allowances, that in a perpetual system, a return of defective merchandise is recorded by crediting the inventory. We'll see later on when a periodic system is used, we actually bring accounts like purchase returns and allowances into play. Don't let that confuse you. On slide 19, here's the example shown on page 234 of the return, debit to accounts payable, credit to inventory, reducing both of them. So understand the logic behind that, because we as the buyer returned $300 worth of goods, so we no longer owe the seller for that amount. But we also have to reduce our inventory to recognize that too. All right, on slide 20, now on to purchase discounts, which is yet another possible adjustment to inventory cost. In these cases, the seller offers the buyer a discount if the buyer pays the invoice within a certain time window, usually 10 days. The seller typically offers either a 1 or 2% discount off the selling price if payment is made within that time window. In today's world, with interest rates as low as they are, this may be more enticing than in earlier decades when interest rates were sometimes in double digits and each dollar that could be invested in a high yield somewhere was a much bigger deal. Nowadays, a 2% discount for payment in a 10-day period may be worth more than before, because you simply can't get that rate of return in very many places in our world. Notice we look at examples such as the one shown on page 235, that the accounts payable liability is for the full balance of the invoice, because at the time of incurring the liability, we have not yet taken the discount and may not have even decided whether or not to take the discount. You can see that the potential advantages for each party shown on the slide. The buyer saves a few dollars and the seller gets his or her cash faster than normal. And with that, we'll conclude this part of the presentation.